Hi, I'm Kep Kepner, CPA here in Dallas. When you're running your business, you need to measure how you're doing. One of those measurements has to do with your liquidity. If you have $100,000 cash in the bank and you go spend it on a piece of equipment, then your liquidity is shot. You have no cash. You got to wait until you collect receivables, or worse yet, you have to take your inventory, go sell it, and then collect the receivables. So you might be short of cash for 3 or 4 months because you spent all the cash that you have. So liquidity measurement is very important to running your business. And there are ways to measure that. So you want to measure it because not only do you want to have cash on hand, you can then make good decisions about how do I want to spend it. Do I want to give myself a bonus? Well, that's okay. You can give yourself a bonus if you want to. But do you want to grow your business? Maybe you should invest some of that liquidity into a good marketing program so you can grow your business down the road. So the way you measure liquidity is not just whether you have cash in the bank. One of the methods you use is to look at the current ratio. You add up the cash in the bank, the receivables that you have, the inventory that you have, and certain other assets like prepaid insurance. That's your number is your current assets. Oh, blah, that's awful. Blah, 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 blah. Okay, so we'll go back to. So one of the major tools is the current ratio. This gives you a picture of your liquidity. The first thing you do is you add up your cash in the bank, your accounts receivable, your inventory, and certain other assets like prepaid insurance. That adds together to be your current assets. Then you look at your current liabilities. Those are your accounts payable. Those are credit cards that you pay off every month. That's the current portion of long-term debt that you have. Add all that together, that's your current liabilities. You want your current assets to be about 2 times your current liabilities. And in that case, you'd be considered pretty liquid. So you have a lot of options when you're liquid. You have an option to change your credit terms so you can sell more, increase your receivables. Maybe you're going to have more write-offs and more bad debts, but you can afford it because you have better liquidity. You can make a decision about investing in marketing so you can grow your business. You can decide to put more money into inventory so that when you sell, you'll have inventory to fulfill your sales orders. So you have a lot of advantages when you're measuring your liquidity. Now that's one way. Another way is to look at what's called your quick ratio. That means everything I can turn into cash pretty much immediately. So on the current asset side, that generally means cash itself and good receivables. Inventory typically isn't included in that because you have to go sell the inventory and then collect from the customer before you end up having cash. So generally it's cash and receivables compared to your current liabilities. Well, that number is going to be a little lower because you excluded some of your current assets. But that tells you really, on a really quick basis, how much cash can I get my hands on and what am I going to have to spend it on. So the current ratio is really important for liquidity management. The quick ratio is a more harsh analysis, but it's how I can turn what assets I have into cash in case I need it right now. If you're not looking at your liquidity this way, and you're just looking at what's in the bank, you need to learn more about how to not only measure your liquidity, but also to use it properly to build your business. If you need help with this, let us know.